India's bond markets have surely got a lot to look forward to, especially now with the inclusion into the JP Morgan index. What's the way forward and how should you invest in debt mutual funds? Here's Abhishek Bisen, Head of Fixed Income with Kotak Mahindra Asset Management Company Limited. Hi Abhishek, and let's start off with the big event, the inclusion into the JP Morgan index. What does this mean for Indian bond markets and for yields as well?
Hi, Mubina. It's a very welcome move as far as the Indian bond markets are concerned and long awaited indeed. So, the way it works is almost $270 billion worth of AUM is follows this index. So, a 10 percentage weight means almost around 25 to $27 billion worth of potential flows can come into India as and when the rebalancing is done. So the rebalancing is going to be done 1% every month. So technically every month you are going to see $2 to $3 billion worth of flows because of the index. So now if you look at the demand supply equation, this is a new catalyst which has come in. So because of which supply remaining constant of bonds, demand is going to increase and which is going to impact the bond curve. And so far, since the announcement has been done, we have seen the interest increasing in the long bonds, that is basically 15 year and above. So the shape of the curve has completely flattened over last 6 to 8 months, which used to be around 20 to 30 basis points steeper, 10 year over 30. Now it is almost close to 5 basis point as we speak. So that is the development, and that is very positive for a medium to long term perspective for Indian bonds.
The RBI seems to be a bit split. That's what the latest minutes showed us, that while some are saying that, yes, inflation is still a concern, there's also, of course, a school of thought that says that it should not come at the cost of growth, this entire, function to curtail inflation. How do you see RBI move from here on?
So yes, it's a complicated equation at this point in time, as we in the technical terms call a K-shape growth, right? So one side you see a distress, one side you see a growth which people are discussing at this point in time. So while RBI at this point in time is probably looking at how the monsoon is going to behave, and we have an important event of budget which is around the corner. So both these events have a different implication as far as the inflation and growth dynamics are concerned. So if the budget is fiscal policy slightly loose as the people are anticipating, which we don't think so, but if it happens indeed, then RBI will have to indeed step back in terms of going towards a slightly easy monetary policy cycle, given the core inflation dynamics going forward. So
now, there's a very important event that's coming up, and that is the budget. But of course, between the last budget and this one, a big event that has transpired are the elections, where the government does not have that big a maturity. Do you see any big announcements in this budget that could perhaps impact the bond market?
Again, it's a tricky one in terms of fiscal balance. So far, the government has been very prudent in terms of their fiscal policy, and they have been sticking to their overall mid to long term goals. Because this is one of the parameters which the international agencies track very closely. And since if you observe, we have been just the outlook has been upgraded to positive by the S&P, and the same is likely to be converted into a rating upgrade, provided we follow our fiscal prudence apart from other things, which is the most important. So given those constraints, so we don't think so that the government coming so close to a rating upgrade, which is again going to be a historical point, going to miss this chance for an upgrade by missing the fiscal prudence path from the medium term perspective.
The rupee has been quite stable despite the fact that currencies in Asia and the emerging markets have been under a bit of pressure. What is lending the stability to the Indian rupee?
So if you recall, we discussed this the last call as well. India is going through a fundamental shift, and a lot of developments happening, which is reflecting into the equities. If you look at the growth numbers as well, so from that perspective, the recent development in terms of global bond index inclusion as well is attracting a lot of bond flows into India. Equity also, we are seeing reasonable amount of flows on a long term perspective. So these flows are giving reasonable amount of stability. RBI is able to accumulate FX, and we must look at in terms of real effective exchange rate. So at times we may depreciate also, but that depreciation is considered as a healthy depreciation, because if you look at from a trade perspective, if we become overvalued, it is going to create a problem later on. So from that perspective, minor depreciation is possible, but on a relative basis, we are going to remain stronger because of our economic fundamentals and the kind of changes happening into the underlying economy.
All right, and to wrap it up, share with us some advice, a strategy that you would recommend debt mutual fund holders to follow.
So if you look the way Indian bond curve has behaved, so this is one of the rare times in my memory of almost 2 decades I've been working. In a bullish fashion, the 10 over 30 has rarely flattened in terms of the spread, has rarely become so close to almost zero. So this shows the commitment of the investors and the long-term positive outlook on the Indian bond curve. So given that, one risk investors is running at this point in time is a reinvestment risk. And how do you avoid that? You just avoid that by investing into actively managed gilt funds or long duration funds. So if it's your investment money, if your long-term money, you must be invested into the longest bucket. Normally what happens is people typically come into a mid to short term kind of bucket and keep rolling it over, because the curve used to be steeper and they used to get that benefit. Now the curve has become flat. So, and the overall structure is decelerating downwards. So there is a possibility when your investments mature, 2-year, 3-year, 5-year investment mature, the overall structure will be at least, it will be significantly lower from current levels. So in value terms, probably that point in time, you will realize how expensive the bet was at that point in time by remaining at the shorter end. So if it's investment money, you need to be in the actively managed gilt fund, because the fund is going to manage your allocation profile, and reinvestment risk is getting taken care of.
All right, Abhishek, thank you so much for joining us and sharing your strategy on debt mutual funds from here on. And thank you, viewers, for tuning in. Stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.